Wherever you are in the world, your investment decisions are often influenced by invisible forces like interest rates. We will be discussing that and more in episode number 2 of the Zurich Money Mindset Podcast, which you can find on the Zurich Money Mindset Hub. I landed in the ocean, didn't I? Hello and welcome to episode number 2 of the Zurich Money Mindset Podcast. Today we are going to be discussing a concept as old as civilization itself, and that is interest rates, what it means for you and what it means for your finances. Now, there are 2 ways that we're going to be thinking about this today. In the first portion, I just want to talk briefly about interest rates as an example of returns on investment and how that money can really compound positively over time in your favor, or conversely can work against you if it is a debt. Secondly, I want to talk more broadly about the concept of interest rates, what they really mean, how they are very broadly set in different economies over the world, and what it means for you with some of your savings and investment decisions as well as your borrowing decisions. Now, if you like our content and, I've been enjoying it so far and want to get caught up on everything and keep in the loop, please do not forget to, as I'm always told to say, so the algorithm knows, like, comment, and subscribe. Click a bell that is somewhere, perhaps down there. I'd say I don't know, but it's perhaps somewhere down there, perhaps it's up there. Click that bell and definitely do subscribe. Now, moving on to interest rates, what are they? Very, very high level concept. It is basically a payment that is received or a payment that is paid for a loan, essentially paid by the borrower and paid to the lender. But it can also be thought of in a more conceptual sense as a return on investment generally. Now, what are some kind of assets that you would think of when we talk about assets or liabilities, should I say, when we talk about interest rates? I mean, these can be for your bank deposit account, your savings account, or on the other side, if you're looking to borrow money, a personal loan. Credit cards will have normally very high interest rates associated with them, as well as mortgages, for example, which are obviously very important for very many people. Interest rates are key input into all of these factors. Interest rates tend to benefit savers when they are high, but high interest rates are not good for borrowers. So they kind of have opposite interests, no pun intended, themselves there. But the point I want to make is this, is that there is no overall interest rate in the economy that is good in of itself, because there are always trade-offs with those. As I said, savers prefer high interest rates, borrowers prefer low interest rates. So it's important to recognize there's no number that you can say is an optimal or a good number. Now, there is, broadly speaking, a reference interest rate that is part of the economy that you are in, whatever jurisdiction, whatever central bank it is. For example, if you are based in a European country, that's a European central bank, that will set effectively a reference interest rate that all agents in an economy, from you to an I to the banks themselves, refer to when they are thinking about what interest rates to set. Mortgages are a huge example of things that people borrow an awful lot of money. It's very important, however, to shop around and look for good deals when you're looking at mortgages, because small amounts of interest changes can make a big difference over a really long period of time. People might have mortgages, for example, for 30 years or even longer, and tiny percentage point changes can have a huge impact for that. So it's really important to understand what's going into that interest and what you're actually paying. Crucially, for the purposes of this podcast, interest rates tend to benefit savers when they are high, but high interest rates are not good for borrowers. So let's start with an important concept here, which is compound interest. That is basically the snowball effect of how either money accrues positively towards you, compounding more and more, faster and faster, larger and larger over time, or works against you if it is debt that you have that is also working effectively with the same kind of logic. The basic idea here is that the longer you invest, the more of that investment will be working towards building returns on previous returns. So you're starting small, but that first year return will create the second year return, and that'll be a little bit larger than the next year. And then the third year will be even larger than that because it is based on the second year, which is already bigger than the first year. And you can kind of think over time about how that scales really, really significantly. Now, the larger the interest rate is and the longer the time period, the faster that accrual will be, or the bigger that accrual will be overall. Now, just to think about this as a simple example, because I don't want to go too much into the math here, but there is a really simple rule called the rule of 72. And how the rule of 72 works is you take an interest rate or you take a return expectation and you take 72 and you divide it by that number. And what you get there is how long will it take for that investment or for the value of that loan that you have to double. So a very, very simple example is if we use a very high number, which is 10%. If you divide 72 by 10, you get just a little bit over 7. And what that tells you, if you start with $100 or 100 euros, if you're investing or borrowing and not paying down at 10% over just 7 years, a little bit over 7 years, that will already be $200 or euros in this example. And you can see here how that really works for you if you are the one who is earning that interest or the one that is investing, and how it can really significantly work against you if you're the one that owes that money and that big balance is building up over you. But the fundamental idea here is that the larger the investment return of the interest rate, the faster that number will move up, and the longer the time period, the more that power of compound interest will have to play out, hopefully in your favor. Now, a 10% number is probably unrealistically high as an overall balanced portfolio, particularly as an investor, and certainly compared to most markets where we look at for the interest rates. But it's a good illustrative example of how the power of that works. If you think of smaller numbers, and even like 6%, for example, you can use the rule of 72 very quickly there. 72 divided by 6, 12 years to still double your money or to double the money that you owe. So you can really see the power of that and hopefully visualize quite quickly with that very simple mathematical trick. So let's move on to interest rates more broadly. How are they generally set in economies? How are they decided, often by central banks? And how do they feed into investment decisions, behavior generally, and how do they feed into your personal finances? Now, I said this is a concept that is old as civilization itself, and I know podcasts these days can be up to about 6 hours, maybe more in length. So I've brought the history of interest rates with me, and I will be reading now for about that period of time. Of course, I joke, the media team is holding their hands in disbelief right now, so let's put that very much to the side. But what really are interest rates? How does this work? There are central banks. They basically act as the bank to all the other commercial and private banks that you might be aware of that you likely bank with. Now, what do? They normally are targeting a certain level of inflation in the economy, and we'll talk about that in much more detail in a forthcoming episode. But they also may want to try and determine levels like growth or unemployment in the economy, and they try and influence that by changing interest rates up and down. The higher the interest rates are, the more that is likely to weigh on inflation as borrowing decisions become more expensive for everyone in the economy, from consumers like us, savers like us, and to companies generally who will have to pay more to borrow that. If they want to stimulate and really create inflation, or try and create inflation, create growth, lower unemployment, they will tend to lower interest rates. And that has the opposite impact, which basically encourages borrowers to borrow and invest that kind of, so for example, in capital machinery from a company, for example, or just from a consumer to borrow and try and stimulate the economy that way. Now, the decisions that they make, they set generally, there's an example here, one interest rate in the economy, and that will change over time, depending on the conditions that they see. Now, everyone else in the economy effectively uses that rate that is set by the central bank as a reference rate. So when a bank is, for example, thinking of how to price a mortgage for you, they will look at how they expect the central bank's interest rate to change over time. They will also look at how creditworthy they think you are as a borrower, and they will also charge you a little bit more over the central bank for that. But effectively what you get is that is how interest rates are decided. So in times of low inflation or of weak economy, interest rates tend to be low. And in terms of very strong inflation or a very, very strong economy, interest rates tend to be high. One thing that is quite interesting in the time we're in right now is we're actually in an environment of much more historically normal interest rates across most of the developed economies. So for example, a few years ago, it wasn't uncommon to see negative interest rates, which are really unusual historically. However, now they're obviously quite a lot higher than that. This is, for some people, a bad thing if you're a borrower or however, if you are a saver looking to invest in longer term fixed savings, this actually can be a good thing. And it's also good, by the way, for the central banks, because if there is an economic downturn, there is now a lot more room for them to actually lower interest rates than in the period, for example, when interest rates were already extremely low. Now, every financial transaction essentially has at least two parties. If you are buying a bond as a saver or as an investor from a government, for example, you are lending to the government that is borrowing from you. So that you're the lender, the government is the borrower. If you have a mortgage on a house, for example, from a bank or a financial institution, you are the borrower and they are the lender there. Now, obviously, as we talked about at the very beginning, you have different incentives with respect to interest rates there. If you are the lender, you want them to be as high as possible. If you're the borrower, you want them to be as low as possible. Now, I want to give two specific examples, one in terms of an asset. So if you, for example, have a savings account with some financial institution, it's always worth checking how does that savings account number compare to the central bank reference rate in the economy. Now, it's not always going to be exact because the market, for example, could expect the central bank is going to cut interest rates, in which case that number should be lower over time anyway, and that may be reflected in the rate. However, it's always worth checking because it can make a big difference for your savings over time. And there is a marketplace out there, and generally, if people are trying to borrow money, they have to offer competitive terms for you to want to lend your money to them. On the flip side, if you are looking to borrow money on a mortgage, it's also very worth considering looking at what is the central bank interest rate in the currency. So for example, the European Central Bank sets that for euros within Europe. Looking at what is the central bank interest rate there and how does that compare to the mortgage that I'm looking at. Now, the longer the term of that mortgage, the less likely that's to be exactly the same as the central bank interest rate or based on the central bank interest rate. However, it's worth noting here that with respect to mortgages, it tends to be priced on the market's expectation of how the central bank rate will develop, but there's also always going to be a little bit of a higher premium the bank will ask you or a financial institution will ask you as a borrower to pay because there are risks to them. There are risks with the house, there are risks with missed payments, for example, but at a very high level, when you're shopping around, it's always worth comparing that interest rate that you see being offered to you by the interest rate that is being set in the economy by the central bank at that point in time. Lastly, interest rates also affect, so much more than just those specific assets, but the economy more generally, as I mentioned before, but they also affect other assets, like stocks that we talked about in the first episode. Now, the relationship is often complicated. You can't just say in advance that it's going to have a very specific impact. However, generally speaking, it tends to be beneficial for stocks and for the value of assets in general when interest rates are lower because the cost of borrowing for people in the economy generally is lower and that stimulates activity. Now, when interest rates go up, that tends to be more negative as the borrowings of companies costs more and more, and that can really weigh on things. So that's worth knowing broadly how that relationship should function. But as I said, it can be quite complicated in reality. Now, that's all we have time for today on the Zurich Money Mindset Podcast. If you enjoyed today's episode, please do not forget to like, comment, and subscribe. And we look forward to providing some more podcasts in the near future.